Hi everyone, welcome back to the sessions on the complex tax environment. A very strong prerequisite to this particular series is looking at the simple tax environment video which we did just before that. So let's just take a plunge. Now, so far, what we've done in simple tax environment is we have looked at two types of taxations in a portfolio, wherein one was the annual taxation, where tax was paid every year, and at maturity, whatever you got was a after-tax portfolio value. The second category that you looked at is that the tax was deferred until maturity, and we had some comparisons that this particular type of taxation gives you a little higher value compared to the values that you get if you are paid annual tax. So but the point there was that there was a single source of income there. I mean, the let's say either there was a capital gain, or there was a dividend income, or so on and so forth, but there was never a situation where you had a dividend plus interest plus capital gain, maybe realized and unrealized, all coming together in context of these two types of taxation pattern. So let's just open up the environment to these aspects as well and see how does the different portfolios behave. Now let's talk about the first case, which is without the unrealized gain. Now this is typically a case. I've taken a very simple case here, where the total return that is being earned every year, let's say 10% here, is the overall return, which comprises in turn of different sources. So we'll read through the slides in a while, but let me just kind of pick up the case so that you can identify the problem. Now it generates 20% of this return. So out of this 10%, 2% at a total portfolio level comes from the dividends. 30% of this 10%, which means 3%, is generated from the interest, and the balance 50%, which is 5%, is your realized capital gains. So that means there are three different sources of income. Now what makes life a little difficult is that the taxation on each of these types is different. In a simple tax environment, we always had cases where the taxations were flat. I mean, all the sources of income were taxed at the same rate. Now here the challenge is going to be a little uphill, because you will have to look at the individual tax rates for each of the sources of income. The ask, on the other hand, the deliverable, on the other hand, from the student expected is exactly the same, which is the effective after-tax return that you would be earning from these sources. Now, I want you to note a point very carefully, that your total percentage of this 10% of the overall return is comprising of 20 plus 30 plus 50. That means 100% of the ingredients are given, which means that there is no unrealized gain stroke loss that you have, and that's what comprise case 1 for me. Alright, so let's take a commonsensical approach, and this is exactly what I have told you to take in your simple tax environment. There have been complicated formulas, but I've always told you to be very, very commonsensical, and let's do it again by the same thing. Now, if I look at it, out of the total portfolio value of 10,000, 10%, which is the total return of $1,000, have been achieved, which has been divided into three particular sources to the extent of $200, $300, and $500. Now these are all your dividend, your interest, and capital gain. Each of these have a different tax rate. So dividend is taxed at 20%, interests are taxed at 30%, while the capital gain, the realized ones, are taxed at 15%, which gives me the total tax that I need to pay to the government in that particular year. So that said, I would be paying $40 as the taxes on dividend, I would be paying $90 as taxes on the interest, and I would be paying $75 as taxes on the capital gain. So to speak, the total tax becomes equal to 205. So that's my tax payment. Now coming back to my basic structure, out of the total pre-tax return, I have paid 205. That means 795 is my after-tax dollar return on a portfolio of 10,000, which gives me 7.95% as my after tax return value. So the answer is the portfolio's expected effective after tax return is going to be 7.95%. And again, I haven't used any formula. It's a pure commonsensical thing. With the blue font is what is written as the incomes, with the red font is written as the tax percentage, and this is the tax payment in the dollar terms, and that's exactly what I've used. Now, honestly speaking, I could do the same thing by the formula as well, and I'll tell you why am I asking you to do it. For the first time I'm bringing any particular formula to you. I've been a critique of these complicated formulas all throughout, but I would be needing you to apply the formula at some stage or the other, okay, in this particular session. So let me just kind of calculate the same 7.95 using this particular formula, a complicated looking formula. So let's just break it down. Your effective post-tax return, this number should be 7.95 at the end of the day, but let's find out. Now this return is a pre-tax return, so you get 10% here, okay, and this bracket is something which needs to be understood well. Now PITI is basically the proportion of the interest. How much is a proportion of the interest? 30%, which is 0.3 multiplied by the tax rate, which is 30%, which is again 0.3. Similarly, this dividend is 0.2 multiplied by 0.2, and this capital gain is 0.5. The proportion of the total return, PRG stands for proportion of the total return from the capital gain, and TCG stands for the tax rate, which is 0.15. Now if I solve for this particular bracket, this entire bracket, I get a number of 1 minus 0.205, which essentially is equal to 0.795, and when you multiply this 0.795 by this 10%, you're going to get 7.95 10%. Now the key here is not to be lost in the formula, but to understand what do we mean by this this particular portion. 0.205 is the portion, the proportion of the annual return which is taken away by the taxes, and therefore the remainder is 0.795 of. Now what is the base of this 0.205 and 0.795? The base for both A and B here is the annual return. It is the annual return, it is not the portfolio. So what portion of the return is taken away as taxes? It is 20.5, and therefore what is remaining with me as in portfolio ready for reinvestment for the next year is 79.5. So the total increase in the portfolio was 10%, of which only 79.5% would be there with me, which means 7.95% of the total portfolio is what I would earn at a post-tax level. So that was my first case, the complex tax environment. I don't know whether you'd call this as a complex environment, which is pretty commonsensical approach from a perspective that you look at it. Let's now talk about, before getting on to the second case where I'm going to bring in the unrealized capital gain as well, let me just do a very quick recall of something that you've already done in your the simple tax environment, and this tax this is something that I would like to do it a little hurried way, because this is absolutely the same slide, absolutely the same example that you've done. So here was a case where the initial portfolio value of 50,000 was earning 12%. There was no other tax except the unrealized capital gain, which after 10 years was sold, and then finally you had to pay a tax of 25% on the capital gain. So herein your 50,000 portfolio was earning 12%, so it became this much, which is equal to, so this is the portfolio value before tax, 155,293. Therefore the gain that you had made is this number less 50,000 is equal to 105,293, and the tax that you got to pay at the rate of 25% is going to be 0.25 multiplied by this number is equal to 26,323, and therefore the value of the portfolio after tax is going to be 155,293 less 26,323 is 128,970. I was getting 69.8, but I've rounded off to 970. Alright, so that's your portfolio value after tax, and this is exactly what we did through commonsensical approach in our simple tax environment. Now I would like to do the same example using this particular approach, which is the this is again the formula approach which the core book or the curriculum has, in which case I'm going to put in the values here in my endeavor to get to the same number of 128,970. Let's just try and see how does the formula work here. So this return is your return that is 12%, which is the return which the portfolio is enjoying every year, and this is the portion of the incremental portfolio value which is reinvested in the business. So we have assumed here in a simple case that the annual taxes are not to be paid now. So entire 12% is something which is let's say 100 value becomes 112. So entire $12 of the return earned in the first year is available for reinvestment for the second year, and you're not paying any tax annually. So so this is the return which is the annual reinvested return in the portfolio. So you get 1 plus 12% raised to the power n as in 10, and then you multiply it by the final tax that you'll have to pay on maturity, and then you add back 0.25. So let's find out the number here. I'm going to get a number of 2.5794. Now this number needs to be interpreted carefully. This is the factor, this is only a multiple which denotes the relationship between the value of portfolio at T0 and the value of portfolio at T10 after tax. So if let's say your value was 50,000, you got to multiply it by this number 2.5794. Let's see how much do we get into 50,000. I'm going to get 128,970. All I'm trying to say is, whenever you look at a formula like this, please do not be confused, do not be surprised, do not be shocked. All we are trying to do is this commonsensical approach. We are trying to basically tax a portfolio not annually but at the end of the at the end of the maturity. And another important point that I want you to highlight is this R. What is this R? This return is the final return which is ready for reinvestment in the second year. So if let's say out of this 12%, I'm hypothetically taking, if out of this 12%, let's say the government says you got to pay 2% tax and it's only 10% which will be available for return for the next year, then I would understand the situation as that this is your annual tax in addition to your capital gain tax that you'll have to pay at maturity, and this must be your pre-tax annual return. Okay, in this case, in this particular case, this has been borrowed from a simple tax environment wherein both the situations never arose together. So either it was an annual taxation structure or it was the deferred taxation structure. Both never happened together in that case. All right, so now I'm absolutely good to take a plunge with the second case, and this is really the end of the entire confusion and everything. So please don't be bogged down as to what is going to come out. There is, I mean, no dinosaurs are going to come out of it. It's very simple and straightforward, and the good news is that you have already done the nut and bolt of the complicated looking formula. What is the case is? The case is pretty similar. The overall return remains 10%. 10,000 was a portfolio value. The average is 10%. The point here now this time is that the 20% of this return comes from dividend, 30% of the return comes from interest, pretty similar to last time, and not 50 but 40% come from realized capital gain, which tells me that 10% must be coming from some other source, and we have mentioned all other sources. What we are left with is the unrealized gain this time. That means that every year the portfolio is also incurring certain unrealized gains. The taxes on each types of returns are, so this stands for the dividend, this stands for the interest, and this stands for the capital gain, which means your unrealized capital gains every year is not going to be taxed, which is typically the case with the tax regime. So how would a portfolio behave in such a case where the unrealized gains are not being taxed? Now here is a case you have not only the unrealized gains, you also have a situation where there are certain annual taxes that you have to pay, which are these, which is going to reduce the return which is available for the investment. So this R that you would find here is this time not going to be 12%, it is going to be much lower than that. Let's see what that number would be. So that's the complicacy that the world is worried about. So this combination is the worst that it can get to, but we are going to talk about it in absolutely in a methodical fashion. So you're going to face a complicated formula like this. This is the point number 3, is really the final frontier. I've divided the final frontier into two parts. The first part, if you look at it, is very similar to the part that you have done just now. It is in fact exactly similar to that. The two small changes: the rate that you see here, in a simple tax environment, is the rate that you earn annually, and you don't have to pay tax on that annually. Now here in the complex tax environment, this rate is going to change. This is where the 12% of a simple tax environment was. And if you talk about the case that you have right now, the overall pre-tax return is 10%. So I am going to, without any hesitation, put 10% here. But 10% cannot be put in here. The reason being that you need to pay certain annual taxes here. And this bracket, 1 minus PITI, so on and so forth, is nothing but what you have done in your previous case, which is right the first case that you did. So what was 1 minus PITI minus PDTD and so on and so forth? So it was the portion of the return which remained in the business and which was available for reinvestment in future. So if you be very, very careful looking at the video, I would want you to pay attention to the area that I am highlighting. This portion, only the PITI and PDTD and PRCG is the portion which is essentially, I'm talking about this number. This is the tax that you have paid, and this is the reduction in the return every year, and which was 20% of 10%. So therefore the return was only 7.95. I'm going to utilize similar stuff here. So I'm going to talk about a very simple formula, very similar formula. I'm going to talk about the same tax payments. I'm going to talk about the same tax payments, and mind it, these are annual tax payments which are going to reduce my annual return which is available for reinvestment in the portfolio. Which means to say that the bracket that you see overall, now I'm highlighting the entire bracket, the bracket that you see overall is again the remainder return which is available for investment in the next year, in each of these years for my portfolio holding. Do you see that the unrealized gain does not find a mention here? It's only the tax on interest, tax on dividends, and tax on capital gain. The reason is, in most of the regimes, in maximum regimes, the unrealized capital gains are generally not taxed. As a matter of fact, the tax payment on that is 0. And as a matter of that, I could have written P unrealized gain multiplied by tax unrealized gain, but then since the proportion would have been 10% and the tax percentage would have been 0, and therefore this entire thing would have become 0. So there is no point writing that stuff. Alright, so I just kind of cleaned the board a bit. So let's just try and put in the values in point number 1, because the value from point number 1 is going to give us that effective rate which is available for reinvestment every year, which is I'm going to put here in. Now, the second change that this formula is going to see after looking at a modified return, a post-tax return, is the revised rate of taxation. Since now this time there will be an after tax, there will be some unrealized capital gain as well, which has not been taxed during the year. I'll have to calculate the average or an effective rate on the entire capital gain. Now this tax is on the realized capital gain as well as on unrealized capital gain. So this is the effective rate, so to speak. It's sort of a weighted average, and we realize that this t% is is going to be much lower than this tax on the capital gain. So in my case that we had, the tax on capital gain was 15%. So let's just find out how much this rate comes out to be. And then finally, we are going to apply the figures and find out the final answer. Okay, so let's go step by step. Let's go step by step onto this particular case. Now, taking the values from the case and putting it in the formulas, first let's calculate that this 10% is not available for reinvestment every year. I have to pay tax on certain realized incomes. So 20%, 0.2 into 0.2. Then it is going to be 0.3 into 0.3, and then 0.4. 40% is part of the capital gain, realized capital gain, which is taxed at 0.15. So the total tax charge or the tax withdrawal is equal to 19%, 0.19, 1 minus, which gives you a number of 81, 0.81 of whatever is the before tax return. So in a way, this becomes 8.1%. How to read it? Let me explain it again. 19% of the before tax return is given as taxes in different forms, so that only 81% of the return is available for reinvestment in the portfolio for the future years. So I get a number of 8.1% here. Alright, so that's the first step, which means that there is 19% of the tax withdrawal. That means 81% of the portion is available for reinvestment. Let's pick up the average or the effective rate of taxes. The tax on capital gain is 15%, and which is written right here. The first numerator, the two complicated looking things, but let's just kind of decode them. The numerator here is the total proportion of the unrealized gain, which essentially means 1 minus 20%, 30%, and 40%. So essentially the numerator is 10%. 10%, the portion which is the total out of the total return, what percentage comprises of unrealized gain. So in my case where the bifurcation was given, it is 10%. And the denominator here is essentially this particular bracket, which means that what portion of the return is available for reinvestment in the next year, which is coming as 81% or 0.81. So I get a weighted average rate on the entire capital gain, because not entire capital gain is taxed at 15%. There are certain gains which are taxed, which are realized, and the balance portion is unrealized. So we get a number of as 1.85%. So in a way, you have to understand that 40% is being taxed at 40% of the total return is being taxed at 15%, 10% is being taxed at 0%. What we're trying to find out is a weighted average kind of a return over the lifetime. Okay, so the weighted average, the effective rate of tax is coming as 1.85, which is what I'm going to apply here, 1.85%, and here 1.85%. And the last thing here in this formula, which we kind of didn't discuss before, is basically the difference in the cost basis value. So let me just explain this again. This B factor is the ratio of the cost basis upon the current value. So in one of the cases that you've done, that although the value of the portfolio was 50, where we will take the value as 45, which makes 5,000 additionally taxable at the rate of capital gain. So that if so, then that factor also comes with as an additional tax payment, so it reduces your overall future value. But if nothing is mentioned, the cost basis is not mentioned, B is always equal to 1, which makes this portion, the yellow portion, equals to 0. So let's just find out how much is the future value. So it becomes like 1.81% raised to the power, let's calculate it for 10 years, into 1 minus 1.85% plus 1.85% is equal to 2.1572. Remember that this is only the multiple that you've got, and you can multiply it by 10,000 to arrive at the after-tax portfolio value after after 10 years in a given complicated situation like this. Alright, so I hope that this issue with the unrealized capital gain is clear. I'm going back to the nut and bolt. So what we did first, given that there is an unrealized gain which is not going to be taxed every year, I will have to first calculate the effective return available for reinvestment. Then I will have to calculate the effective rate of tax on overall capital gain. Some portion is realized, some is unrealized. So this tax percentage on overall is going to be much lower than the tax percentage on the capital gain. And using a new R and a new T, I'm going to rewrite the same formula, something that you have already done in a simple tax environment. No change in the structure of the formula. It's just that if the cost base is there, then I will have to pay an extra tax. In case nothing is mentioned, I assume it to be 0. Alright, so I stopped this particular video. I understand that it's been a pretty longer video. I'm left with the accruals, which I'll do immediately after that. So I wish you all the best. Clear the confusion right now. Reach out to us in case you have any problems. Cheers. Thank you.